Welcome back. Take a look at futures this morning. Mixed market. Dow Industrials flat, up just 1 point, but the Nasdaq is now lower by 34. S&P lower by 1 point after a pretty good rally yesterday. Stocks closed higher with the Dow up better than 200 points at the close. The S&P 500 finished at a new record high yesterday, and the Nasdaq was led by chip stocks and Nvidia. Nvidia leading the charge to that 240 plus gain for the Nasdaq. The stock was up better than 7% yesterday after the semiconductor index was down for 2 days prior. Worst loss in more than 2 months there, so a bit of a bounce back. Nvidia this morning is up again, another fraction, extending yesterday's 7% gain. Joining me right now is Piper Sandler's chief global economist of macro research, Nancy Lazar. Nancy, it's great to see you. Thank you so much for being here. And I want to start right there on the AI boom, because you said this AI boom is slowing down, big capex and construction. Tell us more.
So we do expect capital spending on AI-related hardware to be strong this year, increasing about 20%. But companies are starting to cut back on other capital expenditures. It looks as if the CHIPS Act pulled forward the demand for the construction of a lot of factories. And at the same time, it caused a surge in the cost of buying the equipment for those factories and also the cost of construction. So now you're actually seeing companies cancel and or slow down the development of some of these big factory projects that were announced a couple of years ago. And so a real bifurcation within the capital spending side of the U.S. economy. Unfortunately, AI-related capex is only about 10% of total capex. And so it's not enough to really alter the overall picture from a GDP perspective. So we do expect a slight decline in capex as commercial real estate continues to come under an awful lot of pressure, including obviously the construction or not of office buildings. And then also we think the construction of a lot of these factories, again, that was pulled forward because of the CHIPS Act, is now set to slow down here in 2024.
Well, this is a really important point that you're making, Nancy, because I watch big capex spending as an indicator of the broad global story, the macro story. So if you're seeing, big purchasers, companies, CEOs at those companies slowing down overall capex numbers, does that impact the macro GDP story?
I think that's a great point. We did see in the fourth quarter, companies, again, announced the a delay or pausing of these factories in the fourth quarter. We saw that in the S&P earnings data. Why are they doing that? I think it's the cost overruns, but also at the same time, yes, there are bigger macro issues going on right now. First and foremost, interest rates are up still significantly. Second, banks are tightening lending standards, particularly in the commercial real estate side of the economy. And so we do think this is an example of the lagged effects of all that tightening, both from the Fed and banks, is indeed slowly but surely creeping into a broader footprint of the economy, leading to a more general slowdown, if not an outright recession, as we move into the second and third quarter of this year.
By the way, I would have expected an even bigger impact, okay? Since the Federal Reserve raised rates 11 times, I would have expected a bigger impact, not just on capex, but on a whole host of growth areas for corporate America. Are you surprised that we haven't seen a bigger dent in economic growth as a result of those 11 rate hikes?
Well, something I should have done last year that I did earlier this year is that, on average, how long does it take for a Fed rate cycle to negatively impact the economy? And on average, it's 10 quarters. It's not 4 quarters. It's not even 8 quarters. On average, it's 10 quarters. And so we're just now, it's right now 8 quarters. We're not just now moving into the timeline where the lagged effects of the tightening cycle should be having a negative impact. So I think that we had a couple of false starts, obviously in the third quarter of 2022, expectations for the first half of 2023. And so there's a view that, well, because it hasn't happened, it won't. We tend to disagree with that. We think we are just moving into that period here as we go into, again, the second, third quarter of 2024.
All right, so it's 10 quarters. Very good info there. And I like what you wrote in your most recent report about canceled project mentions. Quote unquote, canceled project mentions in company earnings calls, you say tend to correlate inversely with capex plans, and canceled projects were significant in the fourth quarter. Tell us more.
Absolutely, and it goes back to one, the cost of capital. The CHIPS Act pulled forward the demand. You've had a surge in prices in constructing of these factories. It's up over almost 40% over the past 3 years. The cost of building a factory. Companies are talking about, well, they made these plans 3 years ago that prices were X. Now prices are 40% higher, and as a result, they're squeezing budgets with these cost overruns, and in turn, they are starting to cancel projects. We have our own data where we monitor capital spending plans, and we see similar conclusions there. Also, in our own data, you've seen a clear stalling out, if not outright decline, in companies announcing onshoring into the United States and/or their capital expenditure plans here in 2020.
Yeah, and
in 2024.
And you list them, which I loved. You list a number of companies that actually mentioned it. So what do you think about the rest of the year and these rate cuts we're hearing so much about? Nancy, the Fed is meeting next week, March 19th and 20th. The yield on the 10-year right now is all the way back up to close to 4.2% as the Federal Reserve is kicking off that meeting next week. The European Central Bank policymakers also will likely begin cutting rates during the spring as a victory against inflation is in sight, according to ECB officials. And then you've got the Bank of Japan leaning toward exiting negative rates this month. Nancy, give us your take on the central banks of the world and what happens next.
I think it's a very, very diverse world. Here in the United States, we have clearly sticky inflation. And our point is that unless we do get a very clear slowdown in the economy, recession in the economy, an increase in the unemployment rate, we think inflation is going to stay sticky, and that would postpone Fed rate cuts here in 2024. If our outlook unfolds and you get a higher unemployment rate, then indeed that does mean inflation will slow on a sustained basis, and that then does give the Fed room. But I still think it's a little early to come to that conclusion, given what is perceived to be resilience in the U.S. economy. Europe is really on its back, and it's unfortunate that Germany, which is classically the driver of the European economy, is indeed now a major headwind to the European economy. Basically stagnant growth back to 2019. They are not very productive. They have, if anything, their wage costs are way too high, strong unions. And so at the margin, that has postponed. The strength in wages has postponed ECB easing. We do expect to see, and my colleague Benson, we do expect to see ECB easing, but it's because they are really, really in a very bad place. How aggressive are they going to ease? I think, again, it's going to depend upon how quickly wage inflation slows, and it may be indeed sticky given their unions. Japan, the BOJ, a very diverse world again, indeed. The BOJ, they have had their, put to the accelerator very aggressively. They want strong wage gains. Corporate revenues have soared, profits have soared, which increases the odds. Indeed, you are getting these bigger wage gains, and then that does obviously then increase the odds that the BOJ can start to scale back a little. Japan is our favorite, is still our favorite developed economy because of the profit cycle, which for right now looks very, very strong. The currency has come back a little bit in expectations that they're going to dial back their stimulus. We don't think this is a negative for Japan. We just think that it increases the odds inflation doesn't get out of control. But again, you can't make it in no way is it a synchronized global economy. It's a very diverse global economy right now.
Yeah, well, look, Japan has been the one to watch recently. That's for sure. A lot of money moving into Japan. Nancy, it's always great to talk with you. Thanks so much.
Thank you for your time.
All right, Nancy Lazar joining us. Have a good day.